Welcome everybody to Fundamentals of Public Funds Investments. My name is Carlos Oblites and I am a senior portfolio strategist with Chandler Asset Management. Our friends at CDIAC asked me to join you today to talk about cash flow and cash flow forecasting, an important part of any investment program and any financial program, simply to understand how much money you have available and how you're going to be able to invest it. Most of my comments and my points today will be focused on the actual process of cash flow forecasting. We'll have a little bit of a discussion on the markets and how you can approach structuring a portfolio. But mainly, our focus here is ensuring that you can manage your agency's cash requirements. You are understanding how revenues and expenditures affect the bottom line in terms of cash available for investment. We're going to talk about preparing and implementing a cash flow forecast, and we're going to look at both a budgetary approach to it as well as a statistical approach and discuss some of those instances where one might be more appropriate than the other. So let's dive right in. Taking a look at this structure of a sample agency where you have investments structured out in different maturities, and then you have dates of those known cash flows. And the question to you here is, do these investments, does the structure of this investment portfolio meet the needs for cash flow of your agency? And in this instance, I would say that it does, because you've got a lot of liquidity overnight, and even though you have some cash needs that are being pushed out in further years, you've got plenty of assets that are coming due and available for the day that you need them. And so the answer is yes, it does meet the cash needs. Same story here. We flip forward one page and the question changes. Are your investments optimized for return? And it's exact same chart you were looking at earlier. And the answer here, generally speaking, is no, it is not. And the reason we say that is because for local governments in the state of California, you are effectively limited to investing in fixed income securities. You're a player in the bond markets. And we know that the longer the duration target, the longer that you buy maturities, generally speaking, over long-term periods, the higher your returns will be. And so the more you keep liquid, the more of a cost and opportunity that becomes to your agency. So the question was, are your investments optimized for return? And the answer in this instance is no. There's a better way to approach it and optimize it. So why does this matter? Why do people focus on this? Well, there is a cost to insufficient liquidity besides just the opportunities that you give up and the money you leave on the table. If you don't have enough liquidity, you could have a problem with delayed payments, which for any local government is not good news. You may have short-term additional borrowing costs to be able to cover the shortfall. That's the way the United States government operates. To cover those shortfalls in cash flow, they issue treasuries, and you may have to do some version of that to be able to tide you over until your revenues come in. Generally, we try to avoid that. There's a cost associated with that. There may be additional transactional costs in having to get out of a security early, and even a gain or a loss associated with it when you didn't have to by doing some simple planning. Obviously, you want to avoid internal and external negative headlines whatsoever. And then when you have excess liquidity, when you've got too much on the table, that is lost investment income, which is a real economic impact. Again, bad press, and again, lost opportunity. So obviously, we want to be able to strike the right balance between having enough cash and optimizing it and putting it into work for you as much as you can to earn as much as you can while meeting those cash needs. So you have to ask yourself, when I build my portfolio, number one, am I meeting my code mandated goals of safety and liquidity? Most of you know that California government code has stated goals and objectives for any public portfolio, and they are in order: safety, liquidity, followed by return. And you have to pay attention to those. And of course, the question is, am I going to have the cash that I need available when I need it? And of course, following that is, am I earning as much as I could? That's the kind of thing you have to think about. I mentioned to you that in the bond markets, generally speaking, the longer you target your investments, the more money you're going to earn, generally speaking. And this is just a statement that I make over long-term periods. From one given year to the next, a short duration strategy may outperform a long duration strategy. But when I look at a 10-year or 15 or 20-year period, generally speaking, those longer duration targets, when you're buying longer maturities in your portfolio over a long-term extended period, that tends to net you more return. And that's just borne out by the numbers. Let's look at some of these benchmarks that I put together for you. These are benchmarks comprising treasury securities, and they're divided up by maturity ranges and by their associated duration. So to give you an example, and of course we're looking at the state pool LAIF, which is a very well-run program, very well diversified, but it's really meant to be a short-term investment for local governments. It's a place where they can park cash and be able to pull their money in and out, dollar in, dollar out. There's no really market value fluctuation. But to give you an example here, LAIF is generally targeted at around 6 to 9 months, so somewhere around half a year to a little longer than a year. And that approach averaged for the last 10 years 85 basis points per year. That's what that means. So per year for the last 10 years, ended September 30th, had you been in LAIF, you would have averaged 85 basis points. This is taking compounding into effect. This is a geometric mean. Had you put $100 million in it, it would have grown to $108.8 million, and that's a pretty good return. Looking at a one-year treasury, a little bit longer, the duration is somewhere around a year, the average return now grows a little more, and the overall return on $100 million now grows higher than what you had in LAIF. And that's generally speaking because you are targeting longer duration targets and generally speaking can get higher coupons than what LAIF is doing on an average basis. You would have outperformed LAIF by $884,000, almost $885,000. A 1 to 3 year approach assumes that you're maintaining the bulk of your investments between 1 and 3 years. The average duration is 1.9 years. That approach netted you almost 1.28%. Your 100 million became 113.5, outperforming LAIF by 4.7 million. I think you get the picture. The longer you go here, generally speaking, over long-term periods, the higher the return. It just means that it's an incentive to you to be looking for investment solutions where you're emphasizing longer duration targets with longer maturities in your portfolio to be able to enhance the return. So there is a cost, and that cost is cumulative, and you can see the numbers are very real and very much impacting. So why do we want to bother with all of this? I mean, you could just keep it liquid and you'll always have the money available. Well, looking at GFOA's best practices, the idea here is that a cash flow analysis is intended to measure and assess some government's ability to meet its needs and to negate the need for any short-term borrowing. And I'll let you read the rest of this on your own. And of course, you can download this down later and read it in more detail. But basically speaking, a cash flow analysis is a best practice for any investment program, any financial program. Understanding how your cash patterns fluctuate and how they impact your overall position is a very important thing to do. So what is it? What is the cash flow analysis itself? Well, at the end of the day, you're going to want to figure out how to project your anticipated needs, your anticipated cash receipts, how much money is coming in, and also your disbursements, how much money is going out. The approach will consider all funds, not just the portfolio of invested securities, but also cash in the bank, money invested in LAIF, money invested in other local government investment pools, perhaps at a county treasury, perhaps at in CDs, but everything, even your operating cash at the bank. It considers everything, and it considers the timing of your receipts and your disbursements. What it is not is it's not counting in accruals or any sort of funds that you've budgeted but you don't have on hand. Only spendable cash can be included here. Cash is the operating term here. You want to see a budget of how much actual cash came in when you look at receipts, and not some receipt that you've accrued, because you can't invest in accrual. You cannot invest in accrual. You can't invest cash. So, all right. So how do we approach this? Well, one easy way is to line up your investments with known cash needs. So if you've got cash outflows for a given time period, as you can see in this graphic, you've lined that up. But sometimes that's not possible. Sometimes it's difficult to do that because these needs change over time. Speak to any finance director at any city that works with a public works department that is in charge of CIP, of capital improvement projects, and I can tell you that all those get delayed all the time. and of course receipts of funds get changed around, and projects get extended, and so that's always very difficult to predict what that's going to look like. The other way to do it, of course, is to start thinking about having a pool of liquid balances that you keep liquid at all times. Not always ultra liquid like sitting in a pool available the next day, but some combination of liquid balances that's going to be in play to cover those ins and outs. Anything that goes beyond that liquid balance, that is the piece that you can push out and invest in the longer investment. And that is generally what you try to optimize in the investment program. The trick for you here is to understand the balance, what the correct balance between those two pools is going to be. And we'll talk a little bit more about that, okay? So what are you hoping to accomplish here? Well, you want to identify at least 6 to 12 months of disbursements, and that is the amount that's going to stay liquid. And liquid, what I mean with liquid is anywhere from overnight to invested to no longer than a year. It could be somewhere in between. It could be a pool that averages somewhere around a year, just something that's going to be able to allow you to cover disbursements for at least 6 months. You're also trying to improve earnings. I mentioned that you can match sources of cash and uses of cash, but those core funds is really where you can make that an engine in your investment program to capture higher returns. Obviously, you want to manage any liquidity and market risks, any sort of market risk, meaning that interest rates shift against you and your investments lose value. And of course, you're hoping to, by this exercise, identify any spots, any time along the year, where you may have a shortfall in cash and figure out a way to be able to cover it. One of the nice side effects of this approach is that you can oftentimes see any sort of impending budget problems. If you see that the outflows are outstripping the inflows and your overall cash reserve is going down considerably over time, it can tell you that structurally that you may have a structural deficit that you may have to address down the line. And that is a helpful thing and a helpful warning for any finance director. Okay, so you're going to do this on an annual basis. Generally, you're going to look at the next 12 months. You're going to look at it in 30-day tranches, and you're going to try and build some sort of monthly overview that is going to help you make decisions on how you're going to structure your investments. And then, generally speaking, you're going to try and extrapolate what might that look like for the next 2-3 years, but at least for the very least for the next year. And how do we do it? Well, we start with the beginning balance of your cash and investments position. Remember, it includes everything. And you're going to use the monthly expected revenues and expected expenditure projections to build a model on a spreadsheet. You're going to use that to project a net change on a monthly basis. And from there, it's going to adjust your balances going forward on a month-to-month basis and thereby inform you how much money you have available to invest. From there, you could develop a schedule of your current investments and when you have maturities and coupon payments coming into the portfolio to give you a broader idea of the cash coming in. So start by identifying your major sources. It's going to be revenues like property taxes, TOT, sales taxes, development fees, user fees, any sort of interagency shared revenues, sometimes non-recurring revenues. Sometimes that revenue is coming from financing sources. You have a bond issue and you've got money coming in cash, and you have to figure out when it's going to get used. Also the expenditures, payroll and benefits. That's a major one for a lot of agencies. Payroll and benefits are usually going to be your biggest source of expenditures. Think about whether your agency, when you're dealing with CalPERS, makes a lump sum payment or perhaps makes payments over the months of the year and spreading it out over the course of the year. That'll have an impact on cash flow. Operating expenses, maintenance, debt service. For any given bond, usually that's semi-annually. How many bond issues do you have out there and how much debt service do you make? And then, of course, capital projects and the schedules that are associated with that. As I stated, that's a changing picture and something you have to pay very close attention to. But you may find a lot of this from historical data from your general ledger. Just be careful when you go into your ledger that you're not pulling accruals. You're just pulling a cash budget. Also look into your current budget because this can inform you what your assumptions were for growth factors for both of these broad categories that I showed you in the prior slide here, the major revenues and expenditures. Your budget will inform you how much your department projected these would change, and you can use that to inform your future balances and future revenues and cash flows. In terms of that, also look at capital project spending projections, and then go back and revisit them over and over. Have a lot of communication with your public works. You can also use historical data from your bank, any pooled investments, your schedules of maturities, if you manage them yourself, if you've got a manager managing them for you, or if they're sitting in a pool. All these things will inform you. It may give you some patterns. All right, so here is an example of what you might build. This is a model that I very briefly built actually 2 nights ago, where we start out on the upper left-hand side showing you the cash or the liquid funds balance. In this instance, what I did here is I took an investment program that bifurcated between liquid funds and core funds. I'll show you that in a second. But you have a beginning balance, and then here is where you project what that monthly inflows are going to be. So you can see sales tax, development fees. So these are revenues that are collected, that you anticipate collecting. They net out to $21.9 million in this example. And then you do the same for your outflows. These netted out to $25.3 million, which means that the net change to your $75 million balance here is negative $3.3 million. So that brings it down from 75.5 down to here where I have my cursor, $72.2 million. Now, that's not the entire investment program. I also reserved back $141.5 million, which is a portion that I'm not really dipping into. And you can see that when I project this, when you follow this row here, projected core balance to the right-hand side, it stays steady. It just assumes that I'm going to maintain that and I'm not going to dip down into it because I have this liquid balance cushion that I can use to be able to make expenditures. So here is my new liquid balance, and then you take that liquid balance and you project out the next month. They become your starting balance, and you go through the same process for the next month where you anticipate inflows and outflows will be. And then now here you had a net change of positive 796,000. So you went from 7.193 to 72.989, and that becomes your new balance, and so forth. You're going to do this for the next 12 months. You're trying to extrapolate. This is a look into the future of where you think it may stand. Now, I added another feature at the bottom where every month you can go back and do a true up. You can do a look back and see what actually came in and what actually left, and where your liquid balance ended up and your core balance ended up, and you have your actual balance. But you can use this actual liquid balance to then adjust your beginning balance for your projection the following month. And the idea is that you do this for 1 year. Here's your 1 year projection. You can start by building it out with what happened the prior year. And remember I told you to look at your budget for assumptions. You can use those assumptions to raise or lower these expected revenues and expenditures for the year. Then you do the same for the following year and the following year. And as you go along, you make an adjustment and you add to your projection. This is the generally accepted budgetary approach to being able to figure out how much money you have available for investments and how much needs to be kept liquid. You may start to wonder, is this cushion enough? Is it too much? Do we need to move more into the core balance? Because that core balance is invested in longer securities with higher yielding investments, which can net you higher returns over long-term periods. And this is that interplay. This is where you're trying to figure out where you're going to land and how much you need to keep liquid and how much needs to go out. Here's another approach. This might be more useful in situations where you have a lot of unknowns into the future, but you can generally rely on the past patterns of your investment program and your inflows and outflows to determine what the future might look like. Think county treasuries. Treasury tax collectors may be doing something like this, some version of this. Especially in a county setting, they know their inflows and outflows. They know, and they're very seasonal. They know that in California, you're going to collect taxes up to December 10th, and you're going to collect taxes up to April 10th, and then the following months, it's just going to be a matter of any other revenues that the county makes, and then all the outflows as there's pass-through payments that get made to the different jurisdictions in your county. And the nice thing about this is that, especially when you can rely on those past patterns, you can then extrapolate into the future using some statistics. In this instance, this is a field that we built. It's a model that we built where these peaks and valleys that you see here are the inflows and outflows of cash. And this, again, includes everything, all the cash in the bank, all the investments, all the securities, everything in life, everything but the kitchen sink. And these are the ins and outs. And you can see here that the pattern is every April, May, June, there's a bump up in revenue, and then in the fall it goes down, and then it comes back up sometime in April, May timeframe, and then you repeat the same thing in December, and then April, May, and so forth. So in this particular instance, this is a city, and this is just the way that their revenues worked out. What we're doing here with a different color is we are modeling where their core balances could have been, because that shows you that you still have in the blue enough to cover the ins and outs, and they could have raised this and kept a cushion to be able to meet those ins and outs and still have money to meet the ins and outs. The rest of it could have been invested, the green, into a portfolio of securities. The red just shows you in this instance where the actual portfolio of securities was, and the difference between the top of the green and where the red is, well, that's excess liquidity. It means that you could be a little bit too liquid here, and it means that this money here that's above the red line, that's in the green, could have been redeployed into actual securities for higher return. And keep that in mind. You can use these patterns to then project what it might look like in the future, but again, it really depends on how seasonal your operation is. 99% of local governments are very seasonal, cities are very seasonal, counties are very seasonal, county treasuries, special districts to a great degree. If you're a water agency or wastewater, there's a certain level of expectation when your revenues are going to come in and when your expenditures are going to occur. But we're now living in the age of COVID, and things like TOT, transient occupancy tax, hotel taxes are very uncertain. In some jurisdictions, sales taxes are uncertain. In fact, about the only thing that's proven to be somewhat reliable has been property taxes and sales taxes, depending on where you are. But so just beware. It just really depends on how much you can rely on past data to be able to extrapolate what you look like into the future. All right, here's some challenges you may run across. Systems. If you don't have a good base of systems, if you don't have a good enterprise system to track your accounting, if you're doing everything on a spreadsheet, it gets harder to compile all this data because you need to be able to look at historical data and manage this process. If you need to pull data from different departments and those people are located in various places, that can be a hurdle to getting this together. Sometimes there are certain things elected officials, they're not focused on it. It's not that they don't want to know, it's just that they're focused on other things, and they'd rather you not focus on how the cash is going to get moved around, because there may be a project they may be championing. That can be a challenge to forecasting this into the future. And then, of course, I think the biggest one and the most relevant is just interdepartmental communications, where you are talking to people and asking them how the budget is going to be impacted, and more importantly, how the actual cash balance, the expenditures that they're going to have in their department, and the revenues, and when they're going to get collected. That communication is paramount. And if you're not able to track that, or if there's problems in communication, you're going to have a hard time building your forecast. So that's something always to work on. All right, so when you have the forecast, what are some good practices to follow? Well, always, I mentioned this earlier, always compare your actual results with the forecasted results and make those adjustments to the actual balances and also to your assumptions if warranted. Always do a look back. It's going to help you in the long run. Always follow up with department heads on any slippage of projects in the CIP realm. They happen all the time. Public Works can't control weather. They can't control changes to work orders. So just always follow up, always have constant communication. And then, of course, always update your model, that spreadsheet that I showed you, and then retain that documentation, because you can go back to it and see how accurate you were. Once you figure that out, then you can start figuring out how you're going to deploy that money. You have to think about the cash flow. You just did that. You have to think about code and what your policy allows. You can't just invest in anything. You also have to take into mind your objectives of how you're going to achieve safety, liquidity, and return. And then, of course, You have to look at the markets, and you have to have a conviction of where they're headed, and you have to look and see what opportunities the markets are presenting before you can start investing $1. So let me summarize everything, and this is just the cash flow piece of it. Work to determine how much you need to keep liquid. Check with all your resources. Where are the revenues coming in, and how are they going to change? Where are the expenditures going to come out of, and how have they changed historically, and is there going to be a change to the pattern? Make sure to reduce anything that does not need to be liquid. Don't keep it liquid. Over a long-term period, that equals into an opportunity cost, and that cost adds up, and it becomes big numbers over time. And then, of course, always make sure to remember, per code, safety and liquidity come before return. So now you may say, well, what do I do with that? We'll go a little bit quicker on this part of the presentation because I want to hone in on a couple of things. But how do you invest it? Well, you got to protect principal, you got to provide liquidity, and you have to generate earnings. That's straight out of code. Safety, liquidity, and return. Those are your code mandated objectives. And when you're taking care of that, you have to make decisions on an investment portfolio. And generally speaking, there are 4 areas where you have to have a conviction and a decision on what you're going to do with a fixed income portfolio. Sometimes we call this the 4 pillars of fixed income investing. Sometimes I call it the 4 levers that you can pull to control risk and drive return in a fixed income portfolio. They are portfolio duration. That's the average. It's very similar to average maturity, but it gives you the impact to your portfolio for a given interest rate shift. And we know that when you, rather than buying maturities willy-nilly, when you target a duration target, you can start putting a level of expectation to the amount of return that you might achieve and the amount of volatility that you might see. Oftentimes we target based upon what a benchmark does. And I showed you some benchmarks earlier, and we'll target near a benchmark because that gives us that level of expected return and volatility. You also have to have a conviction on what sectors you're going to buy, and you're going to have to make decisions on when to rotate them. How much in treasuries, how much in agencies, how much in corporates, what's appropriate, and how much risk am I taking on, and am I getting paid for that risk? You're going to have to think about the term structure of your portfolio. It means, how much do I buy between now and 6 months? How much money do I put in maturity between 6 months and a year to 2 years, 2 to 3 years, and so forth. And the structure of that can have an impact on your returns and your volatility. And then lastly, you have to make a decision on what securities to buy. You have to look at the credit quality. You have to understand stories between issuers and industries, and find deals out there wherever possible, finding undervalued bonds that offer you the greatest return potential for the lowest amount of risk. That's generally the way to do it. We talked about bifurcating the portfolio into liquidity funds and core funds, and here's what I want to say with this slide, very important. When you keep liquid funds, that's one strategy. And you've got core funds associated with that, that dictates a different strategy. With liquid funds, it could be just maintaining it in a local pool. It could mean LAIF. It could mean matching known maturities to known expenditures. It could mean just buying a really short-term paper in the money markets, and that works for liquidity. It's not going to be a big return-driven approach. It's going to be a liquidity-driven approach where you have liquidity available when you need it. Anything that remains that's not needed for liquidity, those are your core funds. And this is where you can target those duration targets that I mentioned earlier. And you can buy longer term securities, and you can rotate sectors, and you can find undervalued issuers, and you can do a term structure that supports your overall investment program. This is where the big play is in. Oftentimes we see that most agencies have resources to do this really, really well. With this, they have some resources, but not as many as might be needed to run a really, really tight investment program. But public agencies do it every day. They do a good job of it. As long as the money's there, as long as it's safe, it's liquid, and you're earning something on it. Okay, so in terms of structuring maturities, I want to focus on that because this is tied directly to liquidity. And here's an example of where you have known outflows, and you've matched your investments to those outflows. That's one term structure. Another term structure you can think about is laddering it. this makes managing your program really easy because you have a known amount of money coming in at a discrete time period, and there's a certain level of expectation of how much money you're going to have coming due from your investments that it's going to be available for cash needs. The problem with this one is not a problem, but you're not fully optimized here. At least you're pushing money out into the longer ranges to pick up yield. But we know that the yield relationship between shorter maturities and longer maturities shifts. It's not linear. And so this is not necessarily fully optimized, but it does make liquidity management much more approachable and much easier. Here's a term structure where you're now starting to think about the value and the yield being provided in different maturity ranges. In this instance, this is an instance, we call this a bullet because you've focused a lot of your investments in one particular maturity range, and it said that you're bulleting 1 to 2 years. You're doing this because maybe you anticipate that yields out here may be dropping and you want to push further out here and maybe a little more here and here, but the bulk of it in a range because as rates fall, two things are going to happen. The value of these investments are going to go up vis-a-vis this side of the table, the shorter side of this chart, the left, and the value of these will go up. And also, when you're buying out here, you're generally buying higher yielding securities, which will hold that yield for longer than if you stayed shorter. If you kept everything here and rates fell, it means you're going to have to reinvest in those lower yields faster than somebody who's invested out longer. So this is another structure. Yet another structure that we see often is called a barbell. And the barbell structure is another attempt to optimize the overall relationship in yield between short maturities and long maturities. I'm going to show you a chart on that. It's called the Treasury yield curve. We'll take a look at that in a minute. But basically, in this instance, this is an investor where the yield curve itself, that relationship in yields between short and long, is such that maybe rates are rising and the longer end is higher yields than the shorter end. I'll show you one of those in a minute. But what you're doing here is you're investing out here to pick up that higher yield in longer maturities. At the same time, you're keeping your powder dry in shorter maturities to make sure that you have more to redeploy in longer as rates rise. And that can be a very successful approach to structuring your maturities. It just depends on the shape of the yield curve. Overall, I want to say this. Remember how I said longer generally pays you higher than shorter when you stay longer, a longer average maturity and a longer duration on average? Here's the numbers that bear this out. But what we've done here is we put together a benchmark study to give you an idea and to quantify the risk and return associated with, on average, going longer or staying shorter. What you've got here is a 1 to 3 year Treasury and agency benchmark. It assumes there's your range, 1 to 3 years. It assumes you're maintaining your investments between 1 and 3 years. And I'm going to go to this line titled modified duration. It averages 1.86 years. This benchmark here, 1 to 5 years, treasuries and agencies, assumes that you maintain the bulk of your investments between 1 and 5 years, and you're averaging 2.59 years. This is the same thing with corporate securities added to it. This one is a 1 to 10 year treasury agency. It averages out to about 3.69 years is the way that it works. Most of you will not utilize this approach right here simply because most of you are limited to 5 years. Code does actually allow you to go beyond 5 years with treasuries, agencies, with municipal securities, and with negotiable CDs, but you have to have special permission from your city council or your governing board. Generally, it's not appropriate for operating funds, especially in a city setting. Most of the time where I see these is when you're a joint powers insurance authority trying to match your liabilities to your assets, and some of your liabilities may include something like workers' comp, where they have longer duration liabilities. It also works well in water, wastewater, where they're very CIP intensive. There's projects that sometimes go beyond 5 years, and it's a good idea to have investments that go beyond 5 years. But for the most part, most people will not be playing in this 1 to 10 space. But I want to just look at these three, really these two on the left. And here's what I mean. Had you stayed between 1 and 3 years on average, and average about 1.86 years for the last 10 years, your return was 124. Had you gone out to 1 to 5 year range, it was 171. And that's considerable over a 10-year period. But look at the standard deviation. Lower standard deviation in the 1 to 3, higher in the 1 to 5, even higher in the 1 to 10. Gives you an idea of how much more volatile it becomes. You can even qualify this. We can look at the returns on a quarterly basis, and we can see how many of those returns for a given period were negative. Because here's a way to look at it. If you're a finance director, how many times over the course of 20, 30 years are you comfortable going in front of a city council saying, we had a negative return? That's one way to look at it. So between 1988 and 2019, staying between 1 and 3 years, you had 13 quarterly occurrences where the return was negative. You still earned yield, but the fair value of those investments went down for the period more than what you ended up in earning in yield. That's the definition of a negative return. 13 occurrences in the 1 to 3 year approach, 23 in the 1 to 3, 23 in the 1 to 5 year approach. So you can see that it becomes more volatile. Even when you get out to the 1 to 10, even more so. So this is just a way to start putting some numbers behind the concept that longer pays you higher returns on average. But on any given year, shorter may do better than longer. 2018 is a good example of that. LAIF, I think, outperformed anything longer simply because rates were rising and a shorter investment can redeploy faster into higher yields. But when you look at the balance of this over long-term periods, staying longer definitely outperformed. And you can actually see that here. Just looking at LAIF, this is the cumulative growth of $200 million. The growth of $1, but using a $200 million portfolio going back 10 years. And you can see that LAIF was at the bottom of the pack. A very well-run program, very well diversified, but that team has designed that program for liquidity. It means that their average maturity is going to be much lower. It means that on average, they're not reaching out to the longer maturities to pick up yield. And you can see how that returns bore out. But it's a perfect vehicle for those liquid investments where you just need to keep it liquid and you need to earn something because you've got expenditures expected and you're expected to use them. Longer, obviously, the longer you went, the higher the return, but you can even see that growth of $1. The longer you went, the higher the volatility. A very interesting approach indeed. That $200 million became 217 with LAIF, 227 in a 1 to 3 year approach, and 237 in a 1 to 5 year approach. If you went 1 to 10, which most of you won't do, you came out with over $250,000. Not bad. So then let's look at what the curves look like going forward. Here's some pictures of some of the yield curves and where things stand today and in the past. I'm showing you some different yield curve environments. This particular one was a normalized yield curve, steep, meaning that when you looked at 1 month treasuries, 6 month, 2 year treasuries, they were lower, but the longer you went out, the higher the yields were for those treasury securities when you chart them out. That's called a normalized yield curve. Why is it like this? It's generally because you've got a booming economy and there's some degree of expectation of inflation, which means that investors out here are demanding a higher yield to be compensated for what they will lose to inflation. Shorter end is not driven as much by inflationary expectation, but the idea here is that eventually, if inflation is going to kick in, the Fed might raise the federal funds target rate, which will impact these investments in the shorter end, and eventually these might come back up. And this is a really good environment where you might use a barbell that we looked at earlier, okay? If you have a flattening yield curve, it means that two things. It could mean that the Fed is raising rates on the front end. It also could mean, it just depends. It might be a transitory period when opposite of what the Fed may do in a boom, it might be a bust. They're not moving. They've lowered rates, but inflationary expectation is low, and you might see rates come down over here. And depending on what these maturity ranges look like, a bullet or a barbell might make sense. And then you have, and by the way, this period back here, this happened actually at the end of 2018. This is what it looked like. Then you have an inverted yield curve. I'm looking at spring of 2019, where there was an inversion. I just want you to focus on the 5 year and shorter maturity ranges. And in this instance, you had 5 year treasuries were yielding less than a 6 month treasury, meaning you could get more money by keeping your investment shorter than had you locked it out longer. It's the opposite of what we know to be true over long-term periods. It's an anomaly. We call that an inverted yield curve. Generally, it occurs when investors think that there might be a recession down the line, when there might be a slowdown to the economy. And what happens here is that you might be tempted to invest in the shorter maturities because you're going to get a higher yield. But the anticipation here is that these longer rates might come down eventually. Even out to here, they might come down eventually because the Fed might lower interest rates and inflation might not be as strong as anyone thought, and the economy might not grow as faster. So there's going to need to be some level of stimulus, and you might see lower rates. So what do investors do? They buy longer maturity securities, and when they purchase those securities, it drives their prices up, which in turn drives their yields down, thus the inversion. And so here, in this instance, the Fed had started moving rates lower at this stage for an anticipated slowdown. The slowdown did come. It just didn't come the way they anticipated. It came because of COVID-19. But you might be tempted to invest in 6 months rather than 5 years, or even 2 or 3 years, because you're going to get a higher yield in 6 months. Well, what happens? 6 months later, these rates fell, and well, not 6 months later, but these rates started to fall within a year, within 12 months, they started to fall. And this 6-month investment would have been done at a lower yield level, and eventually, again, at a lower yield level 6 months after that, and even 6 months after that, even lower. Where this, had you purchased 2 months here, you would have maintained that higher yield for a longer, if you went out beyond the 2-year range, you would have kept that higher yield for a longer period of time, and thus you would have protected your interest income. So don't always be driven by where you're going to find the highest yield. Have a conviction of where interest rates may end up, and then invest accordingly. That's very important. Here's where we are today. This is as of earlier this week. We're recording this right now on Christmas Eve, and this is a day ago, and you can see where interest rates are. It's starting to be a normalized yield curve, which is a far cry from this inversion that we saw early in 2019, and even a flat yield curve towards the end of 2019. Well, we now have a normalized yield curve, but albeit at a completely different yield level. Notice that 2-year investments back in April of 2019 were paying you somewhere around 2.3%, okay? And 2.3, 2.4, not quite 2.4%. Well, as of yesterday, that investment is paying you, 2 years is paying you right here somewhere lower than 20 basis points. It's somewhere around 12 to 13 basis points, much, much, much lower. Okay, interest rates did fall, and it was as a result of COVID-19, as a result of all the stimulus being pumped into the economy. All right, so that spread, that difference, why am I showing you this? Because the difference between yields out here in the short end and the long end out here to 5 years, that differential has grown exponentially. In fact, it's grown out to the 10-year and even out to here to the 30-year range. You don't invest out here, but we look at it just to get an idea of where the general economy is going. And this is what I'm showing you here. It's that spread, that yield difference between a 10-year treasury and a 3-month treasury. Look at the 10 years, this white line, and this is what the yields did. And then the 3-month treasury, look at here, it was inverted. At this point, you were earning higher yields for 3-month treasuries than for 10, and then it renormalized, and then you can see the yield spread through today. That yield spread right now is 84. Here's it's measuring the spread. Here's that inversion, and then here's that difference going up or down. Right now, it's at 84 basis points. When you look at the average, this histogram on the right-hand side, we're somewhere above the average of somewhere around 55. So what does it mean? It means that there's opportunity to invest. So even though yields are generally lower than they were a year ago, look at the 2-year treasury, 163 a year ago, December 21st, and then as of this past December 21st, 12 basis points. 3-year, 166, today 18. Even though they're much lower than where they were a year ago, you also need to look at it on a relative basis. And it's just an argument for having at least a portion of your portfolio out in longer, because I'd rather earn 18 basis points than earn 8. Now, how much you put in here, you don't want to load up too much. It's just a matter of coming out with an average yield and an average maturity where you're going to be able to have enough short to meet liquidity, enough short to redeploy in rising rates, but something out here to pay you a higher yield than had you just went all in with a shorter approach. Notice LAIF is much higher. LAIF has been coming down dramatically. LAIF was over 2% before COVID-19, and we expect that to continue. The LAIF team expects that to continue coming down even lower, at least as I heard from them in the last training session. I'm going to pause with this. I think the key things are this. Once you've determined what that cash flow analysis looks like, we want to start thinking about how to place it. And we don't just want to look at it where yields are today, but where they may be in the future and where different maturities are paying yield one way or another. I want to thank you for joining me. As always, I'm available for these questions, for questions regarding any of these topics. My information is on this presentation, and our friends at CDIAC can always provide that. But I also want to invite you to stay tuned for a session that we're going to have to cover this in a more applicable or a more applied way. But I want to thank you for your time. I've enjoyed presenting to you today, and also just to stay healthy and safe out there as we overcome this pandemic. Thank you so much, and have a great day. Bye-bye.